Hello and welcome to today's webinar hosted by Market Matters, focusing on resources into FY24. My name's James Gerrish and I'm a lead portfolio manager for Market Matters, and I'm also the portfolio manager here at Shaw and Partners. And I'm thrilled to have so many of you on the line today, particularly our Market Matters members. Thanks for joining today's webinar. And if you're not a Market Matters member, you should be. So stay tuned for the webinar today, and no doubt you'll be getting some information around what I think is a really great, pragmatic, real-time service for Aussie investors. Today's webinar is extremely topical, and before I introduce you to today's guests, who are really knowledgeable in the space, really experienced in the space, I just want to obviously set the scene. There's a huge amount happening in the resource space. We've obviously got this huge thematic around decarbonisation that's going to be a long runway to play out, and we're going to focus on that and some of the key commodities that are involved in that space today. Just to give you a quick rundown of today's participants, we've got Andrew Hines, who's the head of research at Shaw and Partners. He's an industry veteran, been around a very long time, been covering resources for decades. And there's just a quick programming note: we don't have Ben Cleary. Ben Cleary has subbed in what I'm told is a better participant. We've got Todd Warren, who is portfolio manager at Tribeca, really experienced in the space, is on the ground investing in the natural resource space. So great to have Todd on the line today. I'm going to introduce you and bring the guys up very shortly, just after we run through a quick disclaimer that any advice provided in today's webinar is of a general nature only. It doesn't take into consideration your personal circumstances, investment situation or needs. So just take into consideration that disclaimer that's on your screen now. I'm going to bring in the guys now, so you can start your. Thrilled to have both of you being in the resource space. I don't want to take up too much of the limelight here, but I thought, Andrew, you're in a pretty good position to sort of set the scene around what's playing in resources as we move into the back end of 23 and early into FY24.
Yeah, sure, James. Thanks for having me on. Delighted to be here, and Todd, good to see your face as well. So another industry veteran as well. Look, James, obviously, the thematics which you touched on in your opening introduction are the big thematics. Decarbonisation, electrification of everything, the metal intensity of what the world is going to go through in the next decade, 2 decades around decarbonisation and electrification is just absolutely extraordinary. And I don't think markets quite realise how much metal is going to be required to achieve the objectives of what politicians around the globe are now setting in terms of their objectives of net zero, whatever net zero actually ends up being. So it's the big thematics around commodities are huge. I think this is just an extraordinarily good opportunity for people right now to get set in resource stocks, given that this year has been somewhat of probably a weaker year than expected as we've come out of the China COVID lockdowns from last year. And I think the market was expecting quite substantial Chinese growth in the first half of this year, which hasn't materialised. It's been a very anemic recovery in China so far. Interestingly, the Chinese, I think, are just starting to realise that now with some loosening of their credit. They're perhaps the only economy in the world cutting rates right now, where everybody else is lifting rates. The Chinese have set some GDP growth targets this year, which look a little bit out of reach right now. The 5% GDP growth target for this year, they will certainly need to hit the accelerator button in the second half of the year to hit those rates. So, right now, copper price, down where we are at about, $8,300 a tonne. I think, I've seen projections of that number getting up to 12,500 over the next 2 years, or even higher than that. And, look, I think the market can get slightly carried away with the copper price in terms of big picture, where it may get to, and I can talk to that a little bit later as we get through the story on copper. But overall, this is just a great time, I think, to go and get yourself positioned for what is going to be a multi-year, multi-decade even growth in metal demand and what that means for the Australian resource stocks.
So BHP is obviously just a proxy for the broader sector here in Australia. And you touched on a really good point around, if I cast my mind back to 2022, there was a universally bullish thematic rhetoric playing out in terms of commodities, that this huge amount of decarbonisation and the like is going to continue to drive commodities. So you touched on, is China the reason why perhaps the first half of 23 wasn't favourable for commodities, or what was the reason around that, do you think?
Oh, look, I think China is the primary reason, but it's more than just China as well, isn't it? We obviously had a reversal in sort of February of this year, where we realised that the inflation dragon was far from tamed, and central banks then started to raise rates a lot further than I think people were expecting that to happen. So, look, what you need to separate here, I guess, is the big picture long-term thematics of the decarbonisation, electrification themes we're talking about. With, at the end of the day, commodities are cyclical as well, and they're driven by short-term growth in the economy as well. So, you've probably heard of the phrase, James, Dr. Copper, which refers to copper as a sort of the health barometer of the global economy. And the reason why that phrase gets used is that copper generally performs well in an environment of strong global growth, and it generally performs poorly in an environment of global recession. Clearly at the moment we are concerned about how high rates go up. We had FOMC decisions last night, and slightly more hawkish tone from the Fed, even though they're pausing rate cuts or rate rises at the moment, I should say. So we are concerned about the global growth environment. We are concerned about recessionary fears, and that is a negative environment in the short term for commodities like copper, like oil. But that's a small interest cycle within what is obviously a bigger picture cycle. And frankly, it's the reason why I say now is the time to get set, because you can use the short-term weakness because of the concerns around global growth and concerns about China to get yourself set for those bigger picture thematics.
Todd, I'll bring you in here. You're obviously on the ground every day, investing in this space. Supply demand dynamics obviously dictate what commodity prices do, and there's ebbs and flows around each individual commodity. What are you seeing on a day-to-day basis out there, and how should we be thinking about commodities, I guess, from here?
Yeah, thanks, James, and hey, Heinzie. Look, I think all those points that Andrew's been making about the demand side are real and are obviously capturing all of the headlines right now. I think the area which I think is really being forgotten here is the supply challenges that we face. I mean, obviously, yes, all the numbers are quite spectacular with regards to decarbonisation, what that will mean for demand. But the problem we are facing here is that, in terms of, as you say, on the ground investment, is that there is a significant lack of it. We haven't seen enough on the ground investment. We haven't got enough future on the ground investment to meet that demand. I mean, the numbers, and we talk about copper as an example. Copper demand today, in terms of primary copper supply, is sort of 22, 23 million tonnes per annum. Now, by 2030, that number is expected to be something in the vicinity of 30 million tonnes per annum. Now, to put that in perspective, the world's biggest copper mine is the Escondida mine, run by BHP and Rio Tinto, or owned by BHP and Rio Tinto, and it produces about 1 million tonnes per annum. So we need a new Escondida every single year between now and 2030. Now, we've had copper at relatively, actually, in the long term, big scheme of things, relatively high levels, elevated levels the last few years. Certainly on the back of COVID, we saw, a lot of this excitement, as you referred to earlier, James, certainly through, post-COVID into 20, into 21, we saw lots of excitement around what this might hold for resources demand. And we saw copper run to in excess of $4 a pound and actually stay in that vicinity for quite some time. Even at today's level, this is a historically high level. But what people are not cottoning on to is the fact that we've been telling these mining companies that they're terrible allocators of capital. Now, you can argue that's fair criticism, because the history is a little bit spotty, to say the best. But what that has meant is that these guys are now sitting back saying, okay, I'm not going to put the money in the ground. I'm actually going to pay down my debt. I'm going to pay a dividend. I haven't done that for a while. And I'm going to buy back my stock. But I'm not going to put the money in the ground. So now you've got, yes, BHP, if you watch all the ads on telly, you'd be forgiven for thinking that they're a copper producer and it's a significant part of their earnings. And it's actually such a small part, but it's certainly where they see the excitement. And indeed, that's part of the reason why obviously they bought Oz Minerals recently.
Yeah, it's an interesting case around putting less money in the ground and giving money back to shareholders. That's been the absolute thematic over the last couple of years. Shareholders through dividends, etc., have been loving it, but it does create a production gap at a time when we've got this demand side is going to really ramp up over the next decade. You touched on copper and the how difficult it is to make meaningful finds, increase production in a meaningful way. There was a chart on the screen just before. I'm just going to try and put some interesting charts up as the guys are speaking. They may not fully align with what they're speaking about, but it's just to show some commodities, some stocks, etc., that we're talking about and to create a little bit more interest. There was some interesting data out of BHP just around how difficult it is to make copper finds. It's deeper, it's more expensive to do that. And that obviously comes at a time when, as you make mention, Todd, that demand is going to increase pretty substantially. So is there any other alternative for other than prices going higher?
Well, not really. I mean, to your point, there has been money going in the ground. And I think that's the other factor here is just the time it takes as well to bring new supply in. The old rule of thumb was, from first successful drill hole to first production was a 7 to 10 year time frame. That 7 to 10 is probably 15 to 20 now. Aside from those reluctant, shall we say, with regards to actual money going into the ground on behalf of companies, permitting process has never been more difficult. So, that's something that's not going to change. I mean, geopolitical appetite, risk appetite, that seems to be declining. So all of these factors make it very challenging. And without having the commodity price, whether it's copper or something else, go higher, you're just not going to incentivize these management teams to change their behaviour.
But what you've seen in the last 6 months, and I think it's ramping up as we speak. Glencore's involved in some corporate activity. Obviously, BHP's taken out Oz Minerals. It seems to me like there's more desire to go out there and buy things that are already in production, buy established mine, just because of the issues that you touched on, Todd, just there.
100%. It's way cheaper to buy than build. That's the reality. The other problem here, of course, BHP goes and buys Oz Minerals, but it's taking copper supply from your right hand to your left hand. It doesn't actually structurally increase the total supply in the market. Now, does it shift cost of capital and so on? Yeah, potentially. Other efficiencies gained, certainly. But yeah, the buy than build debate does not solve our longer term supply challenges.
Okay, so we're all about trying to guide investors in making money in the markets. Andrew, we've got a bent on resources today. So, copper starting out, we're going to, just before I get onto that, we're going to focus on copper today. We're going to focus on uranium, and we're going to focus on lithium. So 3 interesting areas that probably, uranium probably doesn't get the airtime that it deserves. But focusing on copper right here and right now, Andrew, what are some of the names that you like the look of? We at Market Matters, we've got positions in Sandfire. We held Oz Minerals, but we obviously have lost that position. We've moved on to Sandfire. We've added to it very recently. What do you like in the space? Give our listeners some nuggets.
Yeah, sure. Look, it's actually very difficult, I must say, James, to find quality listed pure play copper exposures. There actually aren't many, and Todd sort of touched on before the fact that BHP, you've got copper within BHP, Rio the same. It tends to get swamped obviously by their iron ore exposure, so it's difficult to buy a copper exposure through buying BHP and Rio. But nonetheless, I mean, we would certainly recommend people own BHP. Yes, there is the iron ore risk in that stock. Half their earnings is iron ore, and there is reasons to think that may come under pressure in the next 2 or 3 years. But BHP, I think, is a good proxy for the industry, and certainly a stock we would recommend. When you get beyond BHP, I mean, one other interesting area to think about is some of the gold stocks, who are also fairly large copper producers. So something like an Evolution, which is it's thought of as a gold producer, but actually has a very large copper component to what it's doing. And analysts tend to talk about evolution, and then they take the copper credits off as a byproduct and talk about low cost production. But if you reverse that around and thought about evolution as a copper producer with gold byproduct credits, well, then it's a very cheap copper producer. Then when you get into the pure play, Sandfire you mentioned is the obvious next one down beyond Oz Minerals. And I think there was a lot of money flow into Sandfire in the market as people exited Oz Minerals and wanted to maintain pure exposure. And I guess part of the issue there now is that Sandfire has had a pretty good run, and it's the asset base is okay without being spectacular, and it's probably not as cheap as some of the other names. Then when you get beyond Sandfire, it gets very, very difficult and a lot smaller. There is one name that I would highlight that we particularly like the look of, which is AIC Mines. A1M is the stock code. It's run by Aaron Colleran, who's ex Evolution, the company I just mentioned before. And effectively, Aaron and his team are trying to replicate the success of Evolution over the last decade, which is start off with this one asset they've got, LOEs, and then build a business around that and grow a copper gold business. So, we quite like the look of what Aaron's up to with AIC Mines.
A1M is the ticker for that. Todd, how are you guys getting exposure in copper, given the bullish view that you outlined before?
Yeah, look, well, A1M actually happens to be our preferred outside of the majors in Australia, but
this was not set up either.
No, thank you. The cue was taken. The check's in the mail. Look, I guess we're thankful we run a global fund, right? But the same problem exists globally, to be fair. There's still a very short list of producers of copper today. There's obviously no shortage of explorers or hopefuls, but it's still a very short list. So outside of that, your big one, yes, is Freeport. So Freeport, certainly we like. This is the Western world, I should say, largest listed copper producer. The only copper producer that is a member of the S&P, one of only two mining stocks on the S&P. And these guys have some of the best copper assets on the face of the planet, both in Indonesia, South America, in Chile, and up into the US. And they've done a wonderful job of, I guess, harvesting their cash flows, the massive free cash that they're generating. They've paid down their debt. This was a stock which, going back to the dark days of late 2015 and early 16, with a 7 or 8 times geared balance sheet, and now they're near net cash. With really what we do like, it's a big cap, but also does have a portfolio of prospects which it could deliver and deliver in terms of growth. But it's the go-to name in the US. It's big, it's liquid, gives you significant exposure to copper and gold, interestingly. It's talked about as a copper producer, but I guess the inverse of what Andrew was just talking about, they're actually one of the world's biggest gold miners, but you just don't hear about it much. But we like Freeport in the global space as our preferred go-to.
We've got Freeport in our international equities portfolio. We've held it for a while, and when you jump onto the Market Matters website, you can always see our viewpoint on the stock, what we've written about particular holdings over time, and the actions that we've taken on that particular stock. So it's pretty transparent there. So I mean, the copper space. I'm interested in your commentary about Sandfire. Andrew, so we own Sandfire. We traded it recently. I think stocks like this, I completely hear you around the relative valuation when Oz Minerals came off the board. Sandfire, I think, got to 722 on the upside, well and truly overdone. But there is a scarcity premium. To Todd's point, obviously investing overseas amplifies your scope, the number of opportunities you've got, and we do invest internationally. What do you think of Sandfire? They've done a pretty good job operationally. Are they going to continue to expand their operations as there's some reports they're alluding to a pretty large acquisition?
Yeah, look, acquisitions will clearly be part of their strategy. Obviously they've got assets in Spain, assets in Botswana. So it's a little more esoteric than your standard, ASX listed copper play. There's nothing wrong with those jurisdictions, and I said there's nothing wrong with those assets. They've had some hiccups, I think, with the initial startup of a couple of them, but they seem to be performing okay. There was recently an analyst site tour to to the Matso asset, which people came back generally pretty positive with what's going and the outlook. But as you say, James, in terms of growth, I think M&A is clearly going to be on the agenda for them. They do have a new CEO in the last 12 months. He's a guy that I know reasonably well, Brendan Harris, who he and I were.
He was an analyst. He was an analyst before.
He was the lead analyst at Macquarie, covering BHP and Rio for many years when I was at Morgan Stanley doing similar. So we ended up in fairly interesting parts of the world together on mining tours, visiting places like Escondida and the like. He's an ambitious guy. He's a very, very capable guy, and I think he hasn't joined Sandfire just to mess around with the existing asset base. He'll try and grow that company into something bigger.
I find it interesting when someone on the financial side goes into an operational capacity, and how that sort of plays into their understanding of the market, their communication with the market. They seem to be more market friendly, has been my experience over the years. They know how to communicate and I guess outline their plans from a market point of view.
Yeah, I think it's a good observation, James. I mean, the challenge if you come out of a financial background into an operations background, you don't have that operational experience, and you'll certainly need to be surrounding yourself with people who have that operational experience to help you out. But Brendan went from a finance role to a role at BHP in investor relations, then into South32, where he was the chief financial officer of South32, and then into an operations role with them at a high level. I'm sure Brendan's well aware of his strengths and his limitations, and I'm sure he'll put people around him who know the operational side well enough.
Excellent. Let's move on. Let's crack on into the uranium space, which is, I've just put a chart of the spot uranium price on your screen there. It's trading around 55 US a tonne. It's been a pretty bullish move over the past 12 months or so. Australia is still quite anti-uranium in terms of that being an option for decarbonisation, etc. Todd, I'll start with you. What's your view from a Tribeca standpoint around uranium and perhaps getting exposure to it?
Yeah, we're big believers in nuclear power, firm believers that this is the only low or zero carbon solution insofar as power generation that can support or be baseload support for the intermittency of renewables. Now, we've been arguably a little bit early to the trade. We obviously wore a bit of some headwinds early doors, but the narrative is definitely shifting. Obviously, more slowly here than perhaps other parts of the world, but we've seen meaningful shifts in terms of governmental support for nuclear power, or at least a recognition, as I say, that this is really has to be part of the future for decarbonised power generation. But we've seen, for example, the US have recommitted to their nuclear fleet, where they generate 20% of their power from nuclear power. They have stepped back from their decommissioning plans in Europe. They've even contemplated adding nuclear power to their sustainable finance taxonomy. In Japan, they are accelerating the restart of their nuclear fleet post Fukushima. And you've now got around the world, which is not really spoken about, a situation where we've got more nuclear power facilities under construction than we've had since the 70s. So there is a sort of this stealth increase in demand for nuclear power. At the same time that, we talked about the supply challenges in copper. I mean, that's tiddlywinks compared to the supply challenges in uranium, where you've got two very big producers in Kazatomprom in Kazakhstan and Cameco in Canada. But outside of that, it's a very, very thin cupboard. And you've got a situation where the supply deficit is 50 million pounds a year and has been for years, and yet we've been working our way through stockpiles, and those stockpiles are done.
So we're coming down to the bottom of stockpiles. I guess the other thing that is important from a geopolitical standpoint is what's played out in Russia. And you made mention of where uranium is produced, but it means it's got to travel. And what's played out in Russia has obviously been an impediment to that. What's your take on what happens, the impact of Russia being, I guess, more out of the market than they have been in many years moving forward?
Well, it's significant. I mean, I touched on the fact that Kazatomprom are one of the biggest producers of uranium. Kazakhstan as a country produces, a decent chunk of uranium, but half of it goes to Russia. Now, of the remaining half, most of that is spoken for by China. So, you've got multiple angles being played here. So, yeah, if you take out Russian supply, which clearly is a challenge, you won't be buying any Russian uranium, clearly. Historically, the source of backup supply was decommissioned nuclear warheads from Russia. Post-Cold War, there was an agreement struck between the US and Russia to decommission nuclear warheads, and that was a source of enriched uranium. That's now depleted. So that's no longer there to back us up. So this all plays into the longer term supply and demand challenge.
So how are you playing it? Are you staying with the big guys, or how do you guys play this thematic that you like?
Yeah, it's a mix. I mean, we own Cameco out of Canada, but in Australia, our preferred name is Boss. We like Boss. That they will be the next producer of uranium, likely by the end of the year. With their Honeymoon Well project in South Australia, they're fully funded and fully permitted and shovel ready essentially. Indeed, they're almost ready to turn it on. So that they will be the next big producer of uranium. We actually bought some Paladin just recently. We went through.
What happened there? It was a flash crash that Paladin dropped down into the 50s, and then it's back up at 70s in a week.
Well, dare I say it, the joys of fake news. The joys when you're not a shareholder, shall we say? So this was a headline that emerged out of Namibia, where they have their project, that there was some prospect of the government taking stakes or nationalising to some degree. That's the way it was reported. What actually transpired was, this was old news. This was some news that came about on the 1st of March, but was reported in Bloomberg in June. And what it actually related to was some recent oil and gas discoveries offshore Namibia, where the government wanted to obviously have a stake in the development of those assets. It didn't or won't pertain to existing uranium deposits or uranium projects in country. So, Paladin obviously suffered. You can see that, that provided, as you can see in that sudden dip, it's been a fantastic buying opportunity.
Yeah.
Stock rallied and more back past that as the clarifications came that it wasn't going to be nationalised in any way, shape or form. And as I said, Boss is going to be the next producer of pounds in Australia. Paladin will be the next producer of pounds in Africa. Now, outside of that, we do like a company that's listed in the US and Canada by the name of Energy Fuels. Trades under the ticker UUUU in the US. And they have the only fully permitted and operational mill in the lower 48 of the US in Utah. So they can produce several million pounds a year. I touched on the fact that the US have recommitted to their nuclear fleet and extended the lives of their nuclear fleet. So we really like that now.
Heinzie, I'll bring you in here. What's your take on the space? I know we've covered it for a fair while at Shaw, and we've, through Market Matters, have written a lot on the back of that. We own in our portfolios Paladin, our emerging companies portfolio, and we've also got a position in Silex, which is a bit of a different take, a little bit of a higher risk take on the uranium story. But what's your view on the uranium space?
Well, you'd won't be surprised to hear that I'm in violent agreement with Todd on the overall market. I think you'd be hard pressed to find a bigger, deeper downturn in a commodity market in the history of the world than what we've seen in uranium in the last 12, 13 years. It's been extraordinary. And that was all because of the accident of Fukushima, obviously. And essentially, this is an industry that went into hibernation for well over a decade, with prices, spot pricing down $20 to $25 a pound. And as a result of that, just no investment whatsoever in the industry. In fact, we were seeing stories about the Germans closing nuclear power facilities, the Japanese never going to restart their fleet. And basically, nuclear was dead as an industry. So why would you go and invest in new capacity? Well, it became pretty obvious, late last decade, 2018, 2019, that decarbonisation was just a pipe dream without nuclear being a key part of it. There is no way the globe meets its decarbonisation targets without nuclear being a significant part of the solution. And that's the big sea change we've seen in the last 3 or 4 years. Governments around the world are now rejuvenating their nuclear programs. But at the end of the day, it's not really a demand story. I mean, demand for uranium will now grow at 3% per annum maybe from here. It's not like a lithium story or a copper story that's all about demand. It's now an industry that's not shrinking anymore. The real story here is lack of supply. And Todd mentioned it before. We've just decimated the producers. They've all gone away. There's no new projects that have been built. I think the way you think about the industry is you've got your big existing producers, Cameco and the Kazakhstanis. They will make money at current prices, and they do, and they'll continue to ramp up a little bit. You've then got all these restart projects, and Boss is a good example of that. Boss with their Honeymoon project that Todd and the Tribeca team we also like. They will be back in production later this year. You've got Paladin with their Langer Heinrich project in Namibia. 2 other projects that similar vein. You've got Lotus with their Kayelekera operation in Malawi. And in fact, one that will be ahead of Boss even in terms of new production is Peninsula Energy with their Lance projects in the US. And they will become the first in situ leach operation using low pH chemistry in the US to come into the market. And that's a restart. They'll be in commercial production within a couple of months. We like any of those companies that are coming back into production. They're going to be coming back producing into a market that's super tight. The utilities need their supply, and there's not a lot of new supply.
So can you just talk through how the uranium market works? Obviously, there's a spot price there, and it's trading about 55 US a pound. But the majority of uranium is contracted to, these are long-term utilities that require long-term supply. Can you speak just how to give our viewers a quick understanding of how that is how it works?
I'll try and do this really briefly because there's a lot of nuance to this. But effectively, you're spot on. There's a spot market, and then there's a term contract market. I would say roughly 90% of all uranium is sold in the term contract market. Only 10% is in the spot market. So, although we see that the chart on the screen there, the spot price, and people focus on that, the real movement behind the scenes is what's going on in the term contracting market. Term contracting historically has been done on average about a $10 a pound premium to the spot price, and that I think will continue through the future. And we are starting to see contract pricing now bump up to that $60 a pound level, and I think we'll get up to 70s and 80s even, because what I was going on to say before is that the third group of companies are the greenfield projects, your Bannermans, your NextGens. They're not going to build new uranium mines unless they can see pricing up at $75 to $80 a pound. So that's where we're going to head to. That's where it's where the utilities are going to need to sign contracts with those guys at those sort of pricing to incentivize those guys to go and build this new production capacity. So, as I said in my opening comment, this has been one of the most extraordinary down cycles in the history of commodity markets in the last 12 to 13 years. If you think this is all over in the first 2 years of the upcycle, forget it. We're talking here about a decade of having to go and rejuvenate an industry again to supply uranium into the utilities. And as Todd very aptly described, we've worked off all the inventories now, and we're short still 40 to 50 million pounds of new capacity. That won't be supplied by Kazakhstan and Cameco. Some will be, but we're going to need NextGen. We're going to need Bannerman in the market. We're going to need new discoveries being brought into the market, and it is difficult to develop new mines. So, I think we're going to see uranium pricing probably above $80 a pound within a couple of years. I think we'll stay at those elevated levels for many, many years. And this will be a sector where those people who are investing today are going to make a lot of money on a multi-year view.
Yeah, I think it's a case where if you think building a new copper mine is difficult, try building a new uranium mine. So, Todd, that obviously fits in your thinking in terms of the supply coming on stream in the near term. So you made mention of Boss, you made mention of Paladin. Can you give us a sense of how much production they're bringing on relative to sort of the the shortfall that's going to be needed?
I won't even touch the sides. The short answer. Look, they're both going to deliver once they're fully ramped up. A couple of million pounds, 3, maybe 4 million pounds. Best case scenario. So, and that's not going to come immediately. So that's we are so far to Andrew's point from being able to plug that gap easily, and it just won't come easily. That's the thing that we are so excited about here. And indeed, Cameco, obviously have some supply, or, NextGen. I mean, NextGen have had, the NextGen project is a wonderful project, but it sits in the wrong part of the basin where they exist, where there's no infrastructure. So it's not a matter of just, putting a mine into production and delivering it into the nearest mill. There's just no infrastructure where their project sits. So that's going to present some big challenges. But it's, this is the beauty of what's going on here with no fat in the system. And when even Cameco, who are the notorious nice guys of the sector, don't want to upset anybody, when they're sitting back saying to a utility buyer, sorry guys, don't even bother calling, we've got nothing to sell you. And indeed, we have never been more bullish about the sector. We have never started a utility contracting phase, as we are entering now, from a higher level. It makes you feel pretty juiced up. And when there's so few ways of playing it, it doesn't take much to move this market.
I'm getting the juiced up vibe, Todd. So you're doing well to convey that. Now let's move on to lithium. We've got 10 minutes remaining, so let's get on to what's been a topic that last year was the must-have. Everyone was incredibly bullish on lithium. I'm going to try and bring up a chart. There we go. That's just the lithium carbonate price. It's actually in US dollars, but it gives you an understanding of sort of the trajectory of the prices that we experienced late in 21, 22, and then it all came crashing down in 23. Todd, I'll give you a quick couple of minutes to give us your take on the lithium space. Obviously, it gets a heap of headlines. We know it's going to be central in battery storage and the like. What's your take here? Have we seen a low in lithium and therefore the lithium producers?
Look, I think longer term, there is no doubt that where the market was wrong was on the demand side. And this is why, things took off so dramatically. The number of recuts and resets of demand models was sort of an everyday process where you had to keep upgrading your demand model. And that's why we had this big chase upwards. Now,
it's extraordinary volatility in that price. Like when you stand back and just look at, something that is so, an essential thing moving forward, incredible volatility.
Yeah. And I mean, I think the caveat I would layer on this is that, we didn't have really very much visibility on what the price is. So, this is the challenge that the market has been dealing with, is an inability to really know what is the price that is being received. And obviously a lot of these miners were not dissimilar to the uranium market, where they were dealing in long-term contracts and weren't necessarily receiving spot. Now, we were dealing with a situation where you're getting old data with a delay and a lack of visibility as to what it is, coming out of China. Or there was a very short list of producers who weren't really necessarily willing to tell you with complete clarity what they were receiving for their product. Certainly when the product price was back in the mid-2020s, when they were at risk of going out the back door. So, things have changed. Obviously, Pilbara's BMX, served to assist in providing some clarity on spot pricing at least. And, it got this, all the froth and bubble occurred with lithium hopefuls popping out of the woodwork. The reality is the world's not short of lithium. We might be short of economic lithium, but also we just don't know necessarily what the marginal cost is going to be of some of the more fringe tons. For example, is it brines? Is it, some of the lepidolites in China? We don't know. And obviously, what you've got, the situation here is that China is still such a significant dominating player in terms of the processing, the downstream processing of lithium into battery grade. So they, only need to stand back from the table for, a day and a half, and, suddenly there's no buyer. So that's what I think, you've largely seen. There was a bit of a pullback in terms of the Chinese appetite for the raw material, and the price collapsed. Longer term, we're still bullish, but there are still some question marks as to what the marginal cost is going to be at the top end of that cost curve.
Yeah, so I think I think from my point of view, writing a daily note to a couple of thousand primarily retail investors and conveying what's playing out in the market. It's you read a lot about the positive undertones in lithium, and our bigger picture demand side is going to be here for the next couple of decades. We're seeing EVs on the road, etc. So we combine the two things and say it only can go one way. But there's so many intricacies in a market like this. There's so many complexities. It's right. It's typical across the commodity space, but from my observation, it's more so in the lithium area. Is that how do you guys think about the complexities there?
I'll jump in and then I'll throw the floor to Heinzie. But look, I think the short answer is yes, absolutely. It's the chemistry is complex. The pricing is opaque still. And with that comes all sorts of challenges, not least from the companies, but then of course the market more generally in trying to navigate the snakes and ladders of lithium investing. But look, I think going forward, as I say, chemistry remains a question mark. What does it cost to extract lithium from lepidolites in China or in Namibia or wherever? Not all pounds are created equal or tons are created equal. We only need to look at the challenges that Orocobre faced in extracting lithium from brines in Argentina. And now they're sort of, it's just assumed that they're going to have success. So, all brines are different too. So there's different challenges, and that will be the case going forward. As I say, DLE, direct lithium extraction. So that's extracting lithium from geothermal fluids, from brines, from brines that are part of oil fields. All of these contain lithium. Are they at concentrations that are economically viable to extract? That's a question, mate.
Andrew, I'll throw over to you just from a bigger picture standpoint. You mentioned China at the outset, and that was perhaps the recovery in China not being as strong as perhaps we were thinking coming out of COVID. EV sales were not as strong as perhaps the market had been positioned for at the start of the year. That probably fed into weakness in the demand side and therefore the pricing in terms of lithium. What do you like in the space or don't like in the space?
Yeah, look, I agree with all of Todd's comments there about, and one thing to remember with lithium, it's still a very small market. So, small markets are prone to extreme volatility. There's such a small market. Companies like BHP are saying that we're not no interest at all in getting invested in lithium. It's just because it's not big enough to make, won't move the dial. That gives you some sort of sense of the scale of the industry. The other thing, and Todd touched on it, which is really important to understand, is this is not your traditional resource industry. So this is not just digging up rocks, selling them to the Chinese or to processors. This is a chemical industry. This is an industry where you're producing chemicals for batteries, and a lot of the value in this industry will be captured by the chemical manufacturers, the battery manufacturers, and then the EV producers. So that's something that the lithium companies, when you're thinking about investing in lithium, you want to think carefully about where in the value chain is the value going to be captured by the lithium value chain. It might not necessarily be in a spodumene producer. It might be, it might not be, but you need to think about the downstream as well and where that's going to be. There is, Todd's right as well. There is no shortage of lithium. It's one of the most abundant minerals on the planet. What is short is, we're going through an almost unprecedented demand growth period. You rarely see demand for a commodity go, from where it has been the last few years to where we're expecting it to be by 2030 with that extraordinary growth in EVs. My personal view is I don't think we'll actually get to those targets. I just don't think it's physically possible for that many EVs to be built. If you add up all the projections of all the car companies, it just staggers me that we're actually going to get there. And access to raw materials will actually probably be one of the limiting steps. So access to nickel, lithium, copper, cobalt, manganese, graphite, the materials you need to make the batteries will probably limit the constraint, which means that therefore we are going to be in an environment where, we call it incentive pricing environment, where the price of the commodities are going to be above the marginal cost of production to incentivize that new supply coming through. And again, Todd's spot on about the difficulty with lithium is understanding what the marginal cost of production is and where that will settle out long term. And what we've seen, I think, in the lithium market in the last 12 months, that incredible volatility was there was a big restock phase the back end of last year where people were buying. They were worried about they weren't going to have enough lithium for their projections. Then the demand sort of fell away with the Chinese lack of growth, and we went through a destock phase. And when you've got a small market and you have a restock and then a destock, you can get extraordinary swings in the commodity price. And I think investors need to have the discipline not to worry too much about that. I mean, it was anyone with any sort of modicum of intelligence looking at the lithium market. It's obvious that $100,000 a tonne is not the right price for lithium carbonate long term. Likewise, now it's obvious that $15,000 a tonne is probably too low. We don't know what the right answer is, but it's somewhere in the middle. What's interesting right now is it feels like we're finding the floor, and it feels like that bounce we've had is probably being set by the marginal production out of China from the lepidolite producers. They're relatively high cost. Their environmental credentials are actually pretty poor as well, because very energy intensive what they're doing. So that's another thing that lithium producers need to think about, is that think about the big picture. Why producing lithium at all? It's all about decarbonisation and about clean energy. If you're producing lithium in a very dirty way, you're not actually solving the problem. Anyway, what do we like in the space? Look, I think you can buy really any of the lithium names. I think longer term, they're all going to be positioned well for an industry that, if you look through these short-term swings, the demand for lithium is clearly going up, orders of magnitude from where we are. And anyone who is a relatively low-cost producer of lithium, whether it's just a spodumene producer, a brine producer, or whether it's someone getting into an integrated, lithium hydroxide or lithium carbonate production facility, is going to have a business model that's going to make money over the medium to long term.
Just for viewers out there, we've got Pilbara in our flagship growth portfolio. We like that. We bought it at lower levels. We also have a position in mineral resources, and in our emerging companies portfolio, we've got Global Lithium, GL1. I'm really conscious of your time, guys. I know it's super busy out there. There's a heap going on. So I'm going to wrap it up there, and thank you very much for your time. I won't get a chance to get the questions today, but just to wrap it up. So we started off with the outlook for commodities generally. We think it's a really bullish time. I concur with both of your views. I know I hate, I don't like sitting here pushing a universally bullish view on our listeners. We're not all about that. We're about having a pragmatic approach, but I completely get the outlook for commodities here. And I think it's a great time over the next 5 years to a decade for knowledgeable investors to make money out of the space. And you two guys are clearly that. And I thank you very much for your time. Just in terms of copper, we've got Sandfire. The guys universally liked AIC Mines, which is A1M. That's a smaller cap copper company here in Australia. And Freeport is also the big guy listed over in the US, FCX US, that Todd, the guys at Tribeca hold, Todd spoke about, and we own in our international equities portfolio. In terms of uranium, Boss Energy seems to be the pick from the panel. That's BOE, if I'm not mistaken. And Paladin is an interesting one here, and obviously Cameco over in the listed over in Canada. It's also listed in the US, and then a little bit less certain around the outlook for lithium. There's a little bit more complexity in that market. So copper and uranium are two of the key picks. Have I summarized that correctly, guys?
Couldn't have said it better myself.
Yeah, no, the terrific, James. Look, one stock I would add to your list there. You did mention it briefly through the discussion, Silex, which I think Silex is a fascinating company. That you mentioned Russian uranium problems. Well, have a look at Silex as a solution for Russian enriched uranium.
Yeah, they're and Cameco owns a stake, and they've got the option to go for more. Is my understanding, Andrew?
That's right.
Guys, really appreciate your time today. As I said, I know you're super busy. Todd Warren from Tribeca, portfolio manager involved in the Natural Resource Fund. Thank you very much for joining us on today's webinar. Much appreciated.
Pleasure. Thanks, James.
Andrew Hines, Head of Research at Shaw & Partners. Really appreciate your insight as always. I deal a lot with Andrew, and he's always got really pragmatic, insightful views on the market. So thanks for sharing those with us today, Andrew.
My pleasure, James.
And to all the listeners out there, we had a record number of attendees on today's webinar. Obviously, there's a lot of interest in the resource space, so we thank you for joining us on today's Market Matters webinar. If you do have interest in Market Matters, jump on the website. There'll be offers going out to you. Thanks for your time as always. Speak to you soon. Bye for now.